ran out of cash. The former chair of Wilco apologises for letting down staff. We'll hear from two chief executives who argue that changing the Companies Act could add £149 billion to the UK economy. Plus, reports suggest the fast fashion giant Shein has filed to go public in what would be one of the biggest stock market flotations in years. Good afternoon, this is Business Live with me, Ian King. The former chair of the retailer Wilco has apologised to the thousands of people who lost their jobs when the high street chain went bust in August this year. Questioned by the Business Committee, Lisa Wilkinson said the company ran out of cash, but she blamed former Prime Minister Liz Truss's mini-budget for one of the reasons behind the company's demise.
I am devastated that we have let each and every one of those people down with the insolvency that Wilco has done. I don't know how to put into words how sad I am that we have let down all our customers, all our team members, our suppliers, our advisors. Genuinely, I don't know what you want me to say, but I have always gone on record.
Sorry was the one word I was looking for, which
you
I
can
didn't
have
hear.
the word sorry, of course. I'm sorry if you wish me to say the word sorry.
I wanted just to give you that opportunity.
No, I thought devastated covered it. I apologise. I wasn't trying to be clever. I am sorry that we are not there supporting all those people anymore.
And we'll have more on that throughout the evening here on Sky News. Now, reforms to the Companies Act inserting purpose into the heart of directors' duties would add £149 billion to the economy. That's a conclusion of a report today from Demos, the think tank which has in the past been a major contributor to Labour Party thinking on the economy. It argues that empowering directors to make decisions based on the interests of wider society and not just the financial interests of shareholders would lead to more long-term investment. Well, joining me now to talk about this is Tessa Clarke, the founder and chief executive of the sharing app Olio, and Douglas Lamont, chief executive of Tony's Chocolonely. Welcome to you both. Tessa, let me start with you. I mean, the problem with this, as it seems to me, is that it assumes that directors aren't answerable to wider society, whereas, of course, they are. You know, they have to obey the law of the countries they operate in.
Absolutely, they do, but the laws don't always take into full consideration the best interests of the people and the planet. And what this very simple solution of the Companies Act, change to the Companies Act, is proposing is revisiting what the purpose of a company is and extending it to take into consideration during corporate governance, during decision-making, the best interests of people and planet at the same time as profit. And this really is very much a reflection of a much-needed discussion around the role of capitalism in the 21st century to kickstart growth for our economy and solve some of the biggest problems.
What happens, though, when the interests of wider society are at odds with those of shareholders?
I think the research that we've come out with today demonstrates that if you take the companies that are following this model already, whether that's B Corps, cooperatives, social enterprises, those companies following this model, finding the balance between people, profit and planet, are outperforming on so many measures, on growth, on capital investment, and on how they support their workers and wages. So what we're arguing is if you apply that approach and that model to all companies through a change to the Companies Act, that shift in mindset drives a huge net benefit, not only just in terms of GDP, the numbers we talked about, 150 million, but also a £5 billion bounce in wages for the lowest paid in the economy. That's a material shift whilst driving strong performance. So this is an economic argument with clear evidence of more and more companies following this model, like ours, are outperforming our peer groups as a result of this approach. You
think there is evidence, then, that you achieve a higher return on capital by taking a sort of wider purview, if you like?
Yes, absolutely, and that's what the report today demonstrates, 149 billion purpose dividend to GDP at a time where the policymakers are at a bit of a loss as to how to kickstart the economy. There's a 7x increase in R&D expenditure with all the jobs that are created off the back of that. And then, obviously, as you've already touched on, the pay increase for the lower paid workers in our economies.
Does it mean, though, that shareholders have to forego higher returns in the short term?
No, I think the whole balance of this is finding the balance between short term and long term. And I think what we're seeing is, companies who get that balance right, invest for the long term while thinking about the short term, outperform. Take examples of my own company, Tony's Chocolonely. We're delivering strong returns for our shareholders whilst outperforming our sector. And I think that is the model where we believe more and more people, we're not showing it's just the right thing to do, it's the smart thing to do. But alone as companies, we can only encourage so much change. We think, we're raising the bar, but we believe government, with a very simple change to the Companies Act, can raise the floor as well and shift mindset in the boardroom.
Has that actually been your experience, Tessa? I mean, have there been times where you've actually thought, well, this is an interesting capital project, but we're not going to do it because it's going to have a detrimental impact on wider society?
So given our business model, we find that our revenue generating and our impact metrics are in lockstep with one another. So we connect volunteers with businesses to redistribute their surplus food. Those businesses pay us to take away that surplus food. So the more food we redistribute, the more revenues we generate, the more impact we have both environmentally and on local communities. But I think what's also really powerful about this model, and something that I know is top of mind for every CEO in the country, is around recruitment and retention of employees. And certainly in our experience, we are seeing that there is an incredibly strong business case from an employee retention and morale situation, because the new generation want to work with businesses with purpose. And we have got sort of purpose quitting taking place at scale in people who are midway through their careers as well.
But that's a really interesting point. I mean, if you look at a company like Tesco or Sainsbury's or Morrison's, they are trying to introduce more sustainable packaging, for example. They're trying to do all these things already. Why do you need to change the Companies Act to make them behave more responsibly?
Because the reality is that their fiduciary responsibility is very clearly defined in the Companies Act, and that is to maximise shareholder returns. And the reality is, given our current model of capitalism, it absolutely is possible to be forced into a situation where you're taking short-term decisions that will maximise profits over the short term, but absolutely do not maximise profit over the long term. And I think that's what today's report is all about. It's about saying that over the medium to the long term, a profit with purpose-based model is one that is going to be fit for purpose for the 21st century and deliver a very clear business case for business leaders. OK,
briefly, if you will, please, Douglas. You've just introduced something called a mission lock at Tony's. What does that involve?
So that involves effectively a mechanism by which our purpose is enshrined in our articles that cannot be changed unless now an independent body agree to any changes to that. So it's not up to the directors or the shareholders to redefine the purpose of the business. It's an independent group whose sole responsibility is to protect that purpose. So over the long term, whoever the board members are, whoever the shareholders are, we can reassure that our purpose for the long term to end exploitation in cocoa is protected, and that reassures all the team that work for us that they know that we were there for the long term, but also it's very clear for future investors in the company what we stand for and what we believe in, and the positive change that we're driving across the whole cocoa sector. OK,
Douglas, Tessa, got to leave it there, I'm afraid. Good to see you both this afternoon. Thank you.
Thank you.
Some other stories for you now. And the Chinese fast fashion giant Shein has reportedly filed to go public in what could be one of the biggest stock market flotations in years. The Wall Street Journal says that Goldman Sachs, JP Morgan Chase and Morgan Stanley have been hired as lead underwriters on the offering, which could happen in 2024. It says that Shein, which was valued at around $66 billion in a fundraising round in May, is likely to aim for an even higher valuation in an initial public offering. Meta Platforms is facing a complaint over its decision to launch paid-for ad-free subscriptions to Facebook and Instagram in Europe this month. The Vienna-based advocacy group NOYB, which stands for None of Your Business, has complained to the Austrian Data Protection Authority that the service amounts to paying a fee to ensure privacy and, as such, contravenes European data protection legislation. Well, Meta argues the service is in line with a recent ruling from Europe's top court. Rolls-Royce said today that it expects to sell between £1 and £1.5 billion worth of assets during the next 5 years. The aircraft engine maker said the move was aimed at reallocating capital to areas where it could generate a better financial return. Well, the news came as Rolls unveiled new financial targets for the period. It's aiming to achieve an annual operating profit of up to £2.8 billion by 2027, with the biggest improvement being targeted in its civil aerospace arm. The shares are up by 5.5% on that news. And Barclays is putting 900 jobs in its UK business at risk of redundancy, according to the Unite union, which says employees affected were informed at 1 o'clock this afternoon. The lender has not commented specifically on the number of potential job cuts, but at its recent quarterly results, it flagged measures aimed at simplifying and reshaping its business. Separately, the Financial Times reported today that Barclays is looking into dropping thousands of investment banking clients and cutting up to 2,000 jobs across its operations. Now, the burgeoning field of fintech is widely described as one of the UK's fastest growing sectors, but opportunities to invest in it are hard to come by. One route open to all, though, is via Augmentum Fintech, the only publicly listed fintech fund in the UK. Well, today, the company, whose £241 million portfolio includes the business banking platform Tide and the digital-first bank Zopa, reported a total return before tax of £893,000 for the 6 months to the end of September. That was up from a loss of £1 million during the same period last year. Well, joining me now to talk about this is Tim Levine, the Chief Executive of Augmentum Fintech. Tim, good to see you today. You make the point in the statement that of your three biggest investments you've made, Tide, Grover and Zopa, plus your cash position, is above your overall market cap right now. You're clearly unhappy about that.
Well, I think as we've seen, the UK market, not just ourselves, has been on sale. We talk about Black Friday and Cyber Monday, but I think the London market has had a year of being on sale. And I think if you look at our discount to our NAV at the moment, north of 50%, I think what we've got to demonstrate is their underlying growth in that portfolio. We've got 24 companies. Our average growth rate of our top 10 was about 82% of the net asset value, has grown at 74% year on year. So putting that into context, we've just heard figures from the Governor of the Bank of England talking about 0.6% growth. And so it's our job to find those outliers in an industry that has a lot of growth to come. And I think if you can identify those high growth businesses and demonstrate that they've got future value, then, you know, there's a long way to go still in the sector.
Yeah, I mean, obviously, for businesses like yours, where the assets in the portfolio are relatively liquid, I mean, this isn't just a problem unique to you. I mean, the property sector grapples with this. Is there a way of persuading the market that the valuations are what you say they are and what your valuers say they are?
I think it's a challenge for the investment trust sector and private equity and venture capital per se. I think there's been a healthy dose of scepticism over the last 2 years as to valuation. I think what we need to do as an industry is demonstrate exits and realisations at or above our net asset value. And I think what we've done so far over the last 5 years is deliver 5 exits, all at or above the net asset value. And I think the more that we can do that, and others can do that, that will give confidence that the underlying valuations are robust.
Yeah, and you actually achieved one in the period of full exit of Cushion, which was bought by NatWest. We featured the deal on the programme at the time. Is there more of that to come, do you think?
So I think the unique nature of fintech is that there are a lot of potential strategic buyers. It's a huge industry. It's an industry that's worth $15 trillion globally in revenue. Surprisingly, it hasn't been disrupted as much as you would think by innovation and by fintechs. It's about 2 to 2.5% market share. So that equates to about 300 billion of revenue. So we think over the next 5 to 7 years, that's going to grow to 1.5 trillion. And the big incumbents have really struggled with their digital transformation. There isn't a week that goes by where we don't read about some of the technology challenges. So I think there's a recognition from the global financial services incumbents that they have to work and collaborate, and ultimately they will be acquisitive. And we expect to see that continue to play out over the next 2 years and beyond.
OK, well, I mean, you do strike a positive note in the statement where you say that although 2022 and early 2023 have been quite quiet, you are seeing signs of an uptick in activity.
So what we saw in 21 and 22 was a huge tsunami of capital come into the market. Some might unkindly call some of that capital tourist capital. That capital has withdrawn from the market.
You mean the Americans? Yeah.
No, I would say there are a lot of kind of smart tech investors in the space. But we did see people that were looking for exposure to the sector at any cost. And I think we've kind of reverted to the mean. I think there have been a lot of fintechs, not just in the UK, but in Europe, that have taken pause and said, do we need to raise in this market environment? But if they want to continue to grow, they need more growth capital. That's what we, amongst others, do provide. And I think as we go into 24 and 25, you've seen it in a market with a lot of headwinds, the underlying growth is strong, and inevitably they will come back to the market for more capital. I think we haven't been as active in terms of new investments because we've been very cautious on getting the right entry price. We're seeing valuations start to drop, but we expect to see them moderate further in 24.
That's interesting. I mean, I see you've got £48 million worth of cash that you're sitting on at the moment. You're not letting it burn a hole in your pocket, clearly.
Well, there's always a danger that when you sit on a lot of cash, that you feel under pressure to deploy that. I think our investors and our investment committee want us to be patient, and rightly so. We think that the market will come back to us in a very positive way. we operate in the world of vintages, and we think 24 and 25 will be really positive vintages for venture capital, in particular fintech, because if you can get the right entry prices, then your returns should be compelling over time.
Nice positive note on which to end, Tim. Good to see you today.
Thank you.
Well, still to come here on Business Live, we'll have a look at how the markets have done this Tuesday afternoon. Don't go away.
I'm David Blevins, and I'm Sky's senior Ireland correspondent. I'm based in Belfast, a city transformed by peace, but still struggling with its past. Politically, the two sides are as far apart as ever, and it's over that question of who has sovereignty in Northern Ireland, the very issue that's been the source of tension here for generations. It takes 60 minutes to cross the Irish Sea. It took the British monarchy a century. I've spent 25 years reporting the journey from conflict to peace.
The political parties of Northern Ireland have reached agreement.
We help you understand the world with us.
Today, we have reached an agreement with the Conservative Party on support for government in Parliament.
We already know what the government gets out of this deal. What exactly does the DUP get out of it? Well, £1.5 billion. Welcome to Winterfell. It's an iconic location in this globally acclaimed drama. Ophelia was the most powerful hurricane this far east in the Atlantic on record. You can't live in a place like this and not appreciate the environment.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Well, the US dollar has slipped on foreign exchange markets today to hit its lowest level for 3 months against a basket of international currencies. That's as investors continue to bet that US interest rates have peaked in the current cycle. Sterling, as you can see, is up nearly 2/3 against the greenback. In fact, I think that is the highest level since the 1st of September against the dollar. The pound also up by about 1/6 against the euro. The single currency, meanwhile, up by more than 1/3 against the dollar. On the equity markets, well, in Europe, it's finished mixed for the day with comments from European central bank officials in which they played down talk of early interest rate cuts next year, weighing on sentiment. The German power giant RWE has been a talking point today. That's finished up 2.75% in Frankfurt after it unveiled investment plans for the next few years and the projected returns from them. Here in London, the FTSE 100 has finished very slightly to the downside. Weakness in some of the dollar earners has weighed on the index there. In percentage terms, the leading faller is Pearson. That's on the back of broker comment, down by some 3.75% there. Hong Kong exposed stocks also trading to the downside on signs of falling house prices in the region. Prudential and Burberry both lower on that factor. To the upside, Rolls-Royce is the leading blue chip gainer this afternoon following those raised financial targets. Look at that, it's finished up nearly 6.25% higher. Outside the FTSE 100, EasyJet is ahead by some 4%. That's after it reported record second half results, while Pets at Home has finished up by just over 2.25%. That was also on a results statement. On Wall Street, equities have edged higher in quiet trading this afternoon. Chip maker Micron Technology is one of the features. That's off 3.25% after warning of higher costs. As for the oil price, well, it's firmer ahead of the OPEC Plus meeting this Thursday. A barrel of Brent crude will currently cost you $82.14 a barrel. That's up a little under 2.75% on the session. Well, joining me now is John Wyn-Evans. He's Head of Investment Strategy at Investec. John, good to see you again. Let's start with US housing. We had some data there this afternoon. What did you make of that?
Yeah, we had the house price data for the 20 largest cities in the US. And once again, house prices are very firm over there, certainly defying expectations from earlier in the year. So we saw house prices on a year-on-year basis up almost 4% across those 20 cities. So still extremely resilient.
It really does feel like a sort of Goldilocks scenario. You are still pricing in the chances of a recession in the US, though.
We still think there is an odds-on chance of a recession in the US developing sometime during next year. That was a consensus opinion, certainly coming into this year. Now it's certainly less consensus, I think it's fair to say. But we're still looking at the sort of the lags of monetary policy making their way through. I think if we look at the housing market in particular, though, there's a few special factors going on there, not least a lack of supply. So with mortgage rates as high as they are, the demand is not what it was, and people aren't going to move houses if that means they lose their old mortgage and have to reprice to a much more expensive mortgage, for example. And I think there's also some evidence that new house builders as well have been helping people along the way, shall we say, enabling them to buy houses.
And also the good old US consumer. It looks like they've just had a bumper weekend over there in retail. There just seems no stopping them.
Yeah, I mean, one of the sort of factors, I guess, for the US consumer, there's a couple of factors I'll mention. One is the famous excess savings that people pulled together during the pandemic. There's all sorts of estimates about how much of those remain. And depending on your methodology, you can either say they're all used up or there's still plenty left. And there's quite a wide range. So I've seen estimates saying there's still, as much as a kind of $1 trillion of savings left, and others saying that they've all run out. So nobody really knows the number. So I think we just have to keep on looking at the consumption numbers.
Are the money supply figures not to be trusted then?
Well, money supply itself is telling you that there is, a reduction in money supply in the economy, certainly. We can see on a year-on-year basis that bank lending is down. But as I say, if there's, people have got cash in the bank, it's there to spend at the moment, it seems.
Yeah, and I mentioned the Shein, the potential IPO there. It's not been a propitious time to be coming to the market, has it?
Well, not recently, certainly. I mean, we've had a couple of failures, might be a bit of a strong word, but certainly Birkenstock and the company behind Instacart, the online shopping business, are both trading below their IPO prices still. Arm did go through that ignominy for a little while, but it's since recovered with the tech stocks over the last month or so. So for another, big, globally important company like this, very high profile to come through, and they're talking, being one of the biggest IPOs of all time. So I think the last round of funding was around about $60 billion valuation. They're talking 80 to 90. And certainly, it would have done well last weekend over Black Friday and Cyber Monday. But you can already see there's competition from other areas coming in. So there's Temu, for example, which has reported very strong growth in that area. There's always somebody there trying to steal your market share. So we'll see. That, it's penciled in for 2024, so there's plenty of water to flow under the bridge till then.
And very briefly, gold continues to go from strength to strength right now. Is that just down to dollar weakness, or are there other factors at play here?
Well, we think there's a little bit more to that than meets the eye. I mean, dollar weakness is certainly helpful for gold as it's priced in dollars. So obviously, if you look at it in sterling terms, it's not going to be doing quite the same. If you look back over the last sort of, 6 months to a year or whatever, you would have thought that gold would not have done quite as well against a background of higher real interest rates, the dollar when it was stronger, and also, inflation having peaked. Those are all factors that are usually would be sort of, not so good for gold. But yet it saw some profit taking. It went down to just over $1,800, but it has roared back. So it's kind of telling you that there is some quite strong underlying demand for it. And that's probably coming from a couple of areas. One is central bank buying. I think central banks around the world, particularly in emerging economies, are diversifying their foreign reserves and putting some of that into dollars, and also, some other concerns as well, geopolitics.
Got to leave it there, John. Good to see you again. Thank you.
Thank you.
That's it from me. I'm back at 11:30 tomorrow. Hope to see you then. Coming up next, it's Simon Mawson with the News Hour. Stay tuned. Cheerio.